American Electric Power, AEP, missed the street consensus on the bottom line for Q2 2026. Operating EPS came in at $1.36, which, misses the $1.48 expectation.
Right, but revenue actually beat expectations.
Exactly. Revenue hit $5.45 billion versus the $5.34 billion consensus. And despite that EPS miss, management actually raised their full year 2026 EPS guidance to a range of $6.25 to $6.55.
Yeah, and the stock opened down about 2.5% to $129.65.
Right, mostly on the bottom line miss and prior equity dilution concerns, but it largely stabilized.
Yeah.
So today we're doing a deep dive into AEP's financial data to figure out how a utility company misses earnings but confidently raises guidance.
And we really need to look at whether their massive 69-gigawatt AI-driven pipeline is actually backed by cold, hard cash, or, if the grid is just going to buckle under all this pressure.
So why the earnings miss despite a 7% revenue bump?
It really comes down to a brutal margin squeeze. I mean, AEP's EBITDA margins compressed heavily, down to 39.61%.
Oh, wow. That is a steep drop.
Yeah, it's down 466 basis points year over year. Now, their vertically integrated utilities did see a slight bump to $302 million.
That was mostly favorable rate cases, right?
Right, which offset lower residential sales from mild weather. And transmission and distribution rose to $239 million. But the corporate all-other segment took a massive hit. The loss there widened significantly to $115 million.
It just from financing costs?
Financing costs and heavy spending on grid reliability, yeah. It's that classic utility trap.
It's like getting a really nice raise at work, right? But then suddenly your mortgage rate resets and your car breaks down.
That's exactly it.
The top line looks great, but your bottom line absolutely feels the pinch, which makes raising full-year guidance after an earnings miss seem completely bizarre. How are they justifying that?
Well, they're banking on an unprecedented forward demand curve. I mean, AEP's contracted load additions through 2030 just surged 69 gigawatts.
69 gigawatts. That is astronomically high.
It is. And to put it in perspective, they submitted 45 gigawatts into ERCOT's Batch Zero process in Texas alone.
Batch Zero.
Yeah, it's basically an expedited review queue for massive power users. Think hyperscalers building AI data centers who want to bypass standard wait times.
Okay, but hold on. Tech companies love claiming space in line for future projects, just to appease their own shareholders.
Right, phantom projections.
Yeah, exactly. Are we just looking at speculative pipeline dreams from tech giants trying to reserve grid capacity they might never actually build?
AEP actually anticipated that exact skepticism. So they are forcing these tech companies to put serious skin in the game.
How much skin?
They've already collected nearly $2 billion in cash and collateral just to back those Texas commitments.
Wait, $2 billion already?
Yes, and more importantly, these are fully executed take-or-pay agreements. So whether those AI data centers actually plug in and use the power or not, AEP still gets paid.
Oh, so it shifts the financial risk entirely away from the everyday residential customer.
Exactly. Because of how these tariffs are structured, AEP projects up to $16 billion in fixed cost offsets for existing residential users.
Okay, so the financial demand is locked in. But, cash doesn't instantaneously spawn copper wires or high-voltage switchgear.
No, it definitely doesn't.
So ask yourself, even with $2 billion sitting in the bank, we are looking at severe national shortages for heavy electrical equipment. If grid logistics or slow interconnection reviews at ERCOT delay these data centers, doesn't the timeline for AEP's expected 9% earnings growth rate start to slip?
That is the massive execution hurdle threatening this entire $78 billion capital plan. They solved the demand side, but now they face physical and regulatory reality. Building transmission lines takes years.
Right.
And regulatory friction is a constant headwind. Like, Oklahoma regulators just decreased AEP's authorized return on equity slightly to 9.375%.
So regulatory bodies cap what they can earn, while physical supply chains delay when they can earn it.
Exactly, pushing revenue realization further out.
Which leaves you with a truly wild scenario to mull over. To keep pace with these hyperscalers, AEP just secured 13 gigawatts of gas turbines.
Yeah, they're even evaluating spinning off a Genco.
Right? A separate, dedicated generation company just to isolate and fund these massive power plants. We aren't looking at a slow, boring utility anymore.
Not at all. The entire nature of the utility sector is being rewritten in real time.
We are watching traditional power companies effectively become direct proxies for the global AI infrastructure build-out.
It's wild to watch.
Follow the show for daily earnings coverage so you never miss a breakdown.